Good morning, my name is Adam from Dodjit.com and this is your video briefing for Monday the 7th of December 2009. Alright, what a week we had. Well, most of the movement actually came on Friday due to the unemployment rate and the non-farm payrolls figure. The unemployment rate really surprised, I think, most economists. It came out at 10%, and the non-farm payrolls, well, wow, that was amazing. Only minus 11,000 job losses were for the month of November. Now that was a really good sign, especially, you know, we've been stating over the last couple of videos how the unemployment figures, how the employment numbers, they're all really important at the moment, especially as various sectors in the economy are starting to improve. And we've got this lagging figure, which was the unemployment data that kept on coming out higher and higher. So I think that was really like a relief for certain investors. Now, the funny thing was that the markets, let's just flip over to a 5-minute chart. I'm looking at the Dow Jones Industrial Average. This is a daily chart. I'm using different charts this time. These charts are net Dania charts. So I'm just going to flip over to a 5-minute chart. Now, what basically happened, this is Friday session. You can see that as the market opened, really the indices, stocks, everything jumped higher. But look at this. Throughout the session, basically lost its steam, dropped down, plummeted lower, and really received like a smack in its face, and then just consolidated around its lower levels of the day. Closed the session at 10,388.90. Now, is this a good sign? Is this a good sign for stocks? Well, basically, if you think about it, the unemployment figure, 10%, which was a drop from 10.2%, should be a good sign for stocks. But I think what basically happened here was that if unemployment now is starting to come down, basically means that if the economy is also starting to pick up, it could mean that the Fed could raise interest rates sooner than expected. And I think this is what really sent jitters down investors' spines a little bit, that the markets have just now started to recuperate. We've received this nice rally, and you know, if economic data is coming out better than expected, if the economy is starting to pick up, then you know, personal consumption will also start to pick up, and that could lead to higher interest rates. Obviously, we've seen this already. The Bank of Australia, they are starting to use certain methods in order to withdraw some of the money that they pumped into the financial system at the start of the year. We've seen that in Australia. They've already raised their interest rates for the 3rd consecutive time. Now, the European Bank, the ECB, they also stated in their last interest rate meeting, which was on Thursday, that they also intend to start to reduce some of the funds in the system. Now, if that's happening over in Europe and it's happening over in Australia, it will probably also happen in the US. Maybe not immediately. I'm not expecting any immediate interest rate hikes, but that's something you have to take into consideration. And because these markets work on expectations, that's basically, I think, what happened. In addition to that, let's just flip over back to a daily chart. In addition, after such a run up like this, look at this, we've had this massive rally higher. I think it's about time we started to receive some profit taking, don't you? Now, we mentioned in our last video that we were expecting an end of year rally. And look at this, the unemployment figures came out and it really didn't break higher. The news was good, the markets didn't break higher. We are still trading in this type of consolidation area, this range. And what I think is that if we don't receive a start of any rally pretty soon, then I don't think it's just going to happen. And what could probably happen is we're going to probably retrace towards the 1,256 level, which is double support. You can see here the horizontal line and the trend line going higher. And then you're going to have to really keep a close eye out on that, because if that line breaks or that level breaks, then we could receive a further pullback. Now, I just want to remind you guys as well, we mentioned in the previous video that for those of you that have really taken this rally higher and you know, you've had some decent profits along the way, you shouldn't really have that much exposure now to the markets, because as the markets have gone up, a lot of people are now starting to look to see whether we're going to continue this rally. Economic news came out on Friday and it didn't push the indices higher, which isn't really that much of a good sign. So it doesn't look good at the moment. Again, we are not turning bearish. We're going to only turn bearish once we break this trend line going lower. So we're going to have to just keep a close eye out on that. Now, another reason why I'm not really that optimistic on this market at the moment is like this. I've just flipped over to the dollar index chart. Now look at this. This was Friday's session. We've had this massive downtrend on the dollar index. Look at this session here. Look at Friday's session. What happened? We rallied higher. The dollar completely rallied higher. It touched its upper trend line and now it's trading roughly around its upper trend line. What I'm thinking is like this. If we break this trend line going higher, meaning that now bullish players are coming back, they're starting to buy the dollar, then we could receive a drop on equities. As we've seen in the past, we've seen that there's been a strong correlation. It's been a negative correlation between the dollar index and the US markets. So obviously, if we're going to receive a higher dollar, if people are starting to buy up the dollar, then what we could see are lower stock indices. What I also want to show you is gold. Look at gold. Look what happened to gold on Friday. This was absolutely catastrophic. For those of you that have been bullish on gold, doesn't look good at the moment. We are now receiving a little bit of stability around this gap around here, but you know, things don't look good. We've got these one like this. Hold on. Got like this. We've got these one. We've got this trend line going up like that, and then we broke this trend line, climb higher. We've now broken out of this secondary trend. We're now retracing to our trend line, which was roughly around here. Again, if you look at the correlations that have been going on over the last couple of months, you would have seen that gold is trading in the same type of direction as stocks. So, you know, gold has now started to plummet. The dollar has started to really rise. Stocks don't look good at the moment. They are consolidating. We haven't turned bearish at the moment, but it doesn't look that good. Now, I just want to flip over to a few different Forex charts and show you the same type of pattern we're receiving. This is the euro against the US dollar. It's a daily chart. You can see also on this chart we've had this massive trend line that we've been using it many times in the past, once, twice, 3 times, 4 times. We have now broken below that trend line. We are still in range, so it doesn't look that catastrophic at the moment, but again, you have to take into consideration that we have broken this trend line going higher. So, you know, things don't look good for the euro. If we just flip over also to the Australian dollar, you can see that also we have now started to range a little bit. We've broken this trend line going higher like that. We are starting to range. What does this mean and what am I looking for, especially in the next coming months? We were expecting a rally towards the end of the year on equities. Normally December, January is meant to be a positive month for stocks, which could probably help dollar counterparts go higher. But as things are starting to progress, and especially after Friday's data, it was better than expected unemployment, the markets didn't climb higher. So what does it mean? Basically, I think we're starting to see a little bit of consolidation. I think we're going to continue to consolidate around current levels. Again, watch out for the charts. You've got the lines. I think that if we do continue high, it's not going to be as strong as we've seen it over the last couple of months. Take that all into consideration. For those of you that have managed to grab profits along the way, now would be a good time to start reducing the exposure, especially if we're going to consolidate a little bit. Let's see how the markets play out. Let's see how they open up this week. Again, we are expecting a little bit of consolidation. Hope you liked the video. My name is Adam from Dodjit.com.